Hi, Scott.
You don't see Apple downgraded very much, especially by somebody who's been bullish, like this analyst has been. What do you make of the call?
I think the research report, there's a couple of good points. What we agree with is the iPhone 15 would probably just be a more of a modest driver in earnings growth for 2024. What we disagree with is we don't think Apple is necessarily trading at a premium valuation. In fact, it's about one standard deviation away from average over the last 10 years in terms of its multiples. We've seen the shares trade much higher. In fact, 2 standard deviations, 3 standard deviations above historical average. And frankly, we think the higher multiples may be warranted since the company's pivoting to more of the services business. So some good points, but overall, we disagree with the research note.
I mean, I think there are many who would suggest that they're not sure that Apple deserves a 28 times forward PE. That's well higher than its historical average. How do we justify it when we know that we've been in an environment, at least, where revenue growth has been consistently slower?
Yeah, I think you justify it with the fact that the services business is a growing part of Apple's hardware business. I think this year, it's a little harder to justify, given that Apple's earnings, to be honest, this year is kind of modest. But looking into 2024 and 2025, you're actually seeing a little bit of an acceleration in earnings growth. So relative to what we see potentially for an iPhone 16 catalyst, we actually are much more excited about the next generation of iPhones than the iPhone 15. We think that's going to be a catalyst for a lot of user upgrades.
Yeah. What about tech overall right now? Certainly looks a little shaky as rates have gone up over the last month. These stocks have come down. So what now? How do you make the case to buy the dip, if you do?
Yeah, it's been tough. I would say since the July 31st month end, markets have been down about 7%. I would say tech has done actually a little bit better than that. If you look at the QQQ, it's actually done better than the overall S&P. However, I do think we're near a bottom here. Perhaps we have a few more down days. The reason why I think that is, number one, I think a lot of the headwinds that we've seen will start to dissipate in the second half of October. We've seen some seasonal tax loss selling from mutual funds that have a 10/31 fiscal year end. They need to do their tax losses by then. We've seen some cash raises really from clients as well, selling for raising cash for California's tax payment, which is about $100 billion that California didn't give to the IRS. I think there was some factors coming from there. And we're also seeing technical factors. We saw the VIX invert. The last time we saw that was back in March, and the market gained about 18% to the highs, and now we're still about 10% from that VIX inversion. So we saw that yesterday. We're about 8% of the S&P stocks are above their 50-day moving average. That typically bottoms out at 5%. So we're seeing a lot of technical data that also suggests that we're getting near the bottoms here.